Like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer. And it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley or throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in December of 2019?
Yeah,
right?
So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So
okay.
Vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV. And to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello,
Hey Danielle, it's Aki.
come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LQ.
Can I take her out for a spin?
Please.
LEQ, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her.
Like,
or that they miss
literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month. How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ,
Yes,
schedule a doctor's appointment.
no problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas. Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
Well, I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy, Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's a reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit
and they say shut up, and then an auto mod bans you. You have to go through that, because until
engage with your audience is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. Yeah, it is Bloomberg Business Week live on this Wednesday, May 17th. Carol Masser along with Bloomberg's Matt Miller. Tim, as you know, is on leave. Hey, we're in our Interactive Broker studio. We're on YouTube. We are on Bloomberg Originals. And this feels like a different tone to the trade today, Matt.
Yeah, absolutely. I mean, we're seeing some big gains here. Well, 1% gains across the board, whether you look at the NASDAQ, the S&P, or the Dow. And I think it all comes after President Biden finally threw in the towel yesterday and said, okay, I'll negotiate to raise the debt ceiling.
Sorry, as I spit. Did he really throw in the towel?
Yeah, of course. He'd been resisting negotiations since McCarthy first reached out to him at the beginning of February and pretty much ignoring the Republicans on the issue of raising the debt ceiling, and finally agreed yesterday, and now hopefully they can get it done in the very little time that they've left.
Well, both sides seemingly yesterday kind of saying, we're going to get this done. We're not going to default. We're going to, figure it out. But I don't know. I guess investors some enthusiasm, which is why we're seeing certainly the equity side of things move up. We got a lot to talk about. We're going to talk about why a group of economists are breathing a bit easier when it comes to the recession, no recession debate. I mean, we could go on and on and on, but we're going to get into this interesting story. Want to talk a little bit about Apple?
Yes,
Apple,
I do want to talk about Apple because I'm excited to see the new products they're planning to come out with, even if they're products that neither you nor I ever buy.
You mean like a virtual headset?
A virtual headset. What even is that?
I don't know.
Yeah,
I already walk into my walls. What am I going to do?
It sounds very clunky.
All right. Well, clunky or not, we're going to get into it with our Mark Gurman. We're going to talk a little bit about retail. Dana Telsey has been following retail forever. So we've got some great insight coming from her. We're going to talk a bit about M&A. We're going to talk about South Florida real estate.
Oh, are you thinking of moving?
I'm not. I kind of like the, northern eastern coast.
South Florida is a good place to visit.
Not yet, at least. Yeah.
I'm not sure if I'd want to live there.
I love Disneyland. I love all that stuff. All right, folks, lots coming up on Bloomberg Business Week with Matt and myself. Right now, though, we're going to talk a bit about the markets with our TV team because countdown to the close, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading day. Romaine Bostic alongside Bonnie Quinn, joined right now by our colleagues Carol Masser and Matt Miller. Welcome to all of our audiences across our Bloomberg platforms, television, radio, originals, and those folks streaming us on YouTube.
Do you have a cold?
It sounds like it.
You sound like
congested.
But you know what, Carol Masser, I powered through because there's nothing more that I look forward to than the 6 or 7 minutes that I get to spend with you and Matt every day around this time.
Wait, do I hear it? Wait, is that sarcasm?
Just because I'm sick doesn't mean I'm not sarcastic.
Well, we love that you're here, but I can hear it. So I hope you're drinking lots of tea with lemon. Having said that, let's talk about the markets. Romaine with a great setup there. Let's talk about the regional banks in particular. I'm sure you guys have touched upon it already in the last hour, but let's pull everybody's attention to it once again because we are seeing regionals once again moving higher. You've got overall as a group, the KRE up about almost 7% here. Western Alliance, you know the news, Bancorp coming out saying deposits had grown up more than $2 billion since the quarter's end, so some worries kind of easing when it comes to regional banks. Western Alliance is up more than 11% here. You've got PacWest up almost 19%, and Comerica, it is top in the S&P 500. It is up about 11% in today's trade, so it's really interesting. And I don't know if you guys noticed this, but the KRE was a top buy among hedge funds last quarter as the fund fell 25%. So just interesting. We've seen a lot of investor institutional money moving into this area.
Yeah, it does seem like investors are breathing a sigh of relief, both on the debt ceiling issue and on the regional banks issue. Nonetheless, there still remains concern about a recession, and you're starting to see more and more people come out and call for the Fed to cut rates as soon as this year, no matter how many times, Scarlett, Jay Powell says, we're not going to cut rates this year. Yeah. Oh, sorry, Scarlett's not there, but she was the one who was pointing that out the last couple of days. We saw JP Morgan Asset Management say they expect a rate cut as soon as the third quarter. I talked to Michelle Girard from NatWest Markets today. She expects the Fed to cut rates, and you're starting to see rates on treasuries really come down, even if, obviously, the Fed says it's going to hold.
Interesting rotation that we're seeing today. You go back to the broader equity markets. I think some of the opening levels were quite interesting because we're now starting to touch to the upside some of those key levels of resistance that have kept this market in a pretty tight trading range. It hasn't quite broken above that range, but for the S&P 500, the key numbers you want to watch are right around that 4170 level. We're at 4153 right now. That's good for about a 1% gain. The Dow and the NASDAQ also up by about 1% on the day, and the Russell 2000, Bonnie, that's your outperformer, up 2% right now.
But you know what's lovely about today's rally? It's not just about the regional banks. It's not just about repairing losses. It's also about the future. It's about airlines, because the top performing group right now is the airlines, 5.9% higher for the group as a whole, and the individual airlines up as much as 6%. IATA, the airline industry, saying that we're going to have forward bookings for the May to September period 35% higher than in the same period in 2022. Now, caveat, that does depend a little bit on Asia Pac, and we have seen some weaker data out of Asia Pac, but certainly the people that were polled, almost 80% of them were looking to take a trip on an airline. So that has the airlines flying higher. Then we obviously have the banks, as Carol mentioned, and then the casino companies. So Barclays upgrading Wynn on evidence that Macau and Las Vegas are going to rebound faster than expected. So this is, all told, a very nice rally, considering we haven't even mentioned the retailers, and they were out with earnings.
Well, let's talk about the retailers here, because all of them are green across the screen. There was some concern heading into the quarter 6 earnings season. We heard from Amazon, of course, a couple of weeks ago. Those shares had actually been on a tear even prior to the rally today, up about 2% right now. Target and TJX, which both reported over the last few hours, Target up about 2.5%, and TJX up about 0.7%. One of the few outliers out there is the Container Store, which is down about 9.5%, though its issues are much more idiosyncratic and kind of divorced from some of the broader macro conditions. In a few hours, tomorrow morning, here on the U.S. side, we do get earnings out of Walmart, and their same-store sales growth has been pretty phenomenal, really going back to the start of the pandemic. We're talking about 6, 7%, 8% same-store sales growth on a year-over-year basis. The expectation heading into the earnings tomorrow morning is going to be for roughly about 5% growth. Even if you back out gas and some of the other things that people like to back out, you're still talking about 5.2%. There's a chart for our viewers here on Bloomberg Television. But that's the setup here. And it raises a lot of questions, guys, about whether some of the concerns about economic conditions were too dour. I think Matt was sort of touching on this too. Were they too dour? Is sort of the resiliency of the consumer going to be enough to kind of keep us afloat?
Yeah, we will certainly see, right? This is the big question. This is the thing that, certainly one of the things that the Fed has to consider, when it looks ahead to its next meeting. Having said that, no surprise to see a big name in the asset management business. We're talking about Jennifer Johnson. She's Franklin Templeton president and CEO. She caught up with our Sonali Basak earlier today, and basically says, we can kind of look at it a lot of different things, but bottom line, you should be in the market. Here's what she had to say.
There's a saying, bears make money, bulls make money, pigs get slaughtered. You'll never time exactly when to get in and out of the market. That is the worst investment strategy you could ever have.
All right, Jennifer Johnson, Franklin Templeton president and CEO, with Sonali Basak at the Salt-Eye Connections event in New York City. Matt, I will say I agree with that, but I also think you can, as an investor, read the tea leaves when things are getting overvalued. There are certainly significant signs when things are undervalued, overvalued in the marketplace.
Yeah, and people who think we're not going to see a recession, those forecasting a soft landing, are very lonely right now because for the most part, the assumption is we do go into a recession. The problem is those assumptions are getting pushed back, right? Are we in a recession now? Fewer and fewer people are saying that. It's going to come in the third quarter. It's going to come in the fourth quarter. But you do see, softening of demand. Even Target said in the short term, right? Even if it keeps its long-term goals. Walmart also, we'll see what they have to say tomorrow, but it'll be very interesting after Home Depot dropped its forecast for the year. So are these consumers really holding up, I think, is the main question here. Obviously, the biggest part of the economy. Are their bank balances still holding strong because they're putting a lot more money on credit cards and they're not saving anything?
I think when we talk about, though, the pushback, Matt, when you talk about pushing back the date of when these people see the recession starting, a lot of that has been really because all those things you just talked about didn't really end up being kind of that worst case scenario, right? I mean, yeah, it's softer, but really, we came into this year and a lot of people really expected some of those numbers, meaning the household balance sheets, credit card data, delinquencies, all that to really just kind of fall off the cliff. And at least as of right now, as we sit here in mid-May, it hasn't. That, of course, doesn't mean it's not going to do it by the time you get to June or July, but it's been long enough where I think a lot of people are starting to say, okay, maybe we were a little bit too aggressive in some of those recessions.
Look at auto sales, right? Auto sales have held up strong in the face of much higher interest rates.
Well, and I will just say real quickly, we have got to wrap, but last year everybody was saying at Milken they thought the recession would be over by this point, and here we are still kind of waiting for at least the economic recession. We've had the earnings recession, right? We've seen that. All right, guys, we're going to continue in less than an hour's time. We'll be back. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. Join us at 4 p.m. Wall Street time for Beyond the Bell.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody. Matt and I are going to rejoin Vonnie and Romaine at 4 p.m. Wall Street time to count you down to the close on this Wednesday. In the meantime, something we wanted to get to yesterday and got kind of thrown off course because of the budget negotiations is just kind of doing a deep dive into Apple, because it's definitely been an outperformer, easily outperforming the NASDAQ 100 this year, just a little bit higher in today's session, but it's up more than 30% here this year. So a lot of news that has been going on. Berkshire Hathaway upping its current holdings. We got that over the weekend. But we wanted to check in with our own Mark Gurman, who follows this company inside and out, breaks exclusives. He's Bloomberg News Chief Technology Correspondent. And Mark joins us from our LA Bureau. Mark, it is good to have you here with us. And one of the reasons we kind of wanted to dig into it is there are some questions about the valuation of Apple, and what are the catalysts that kind of get this there? When you look at this company, what does the next 6 to 12 months look like?
Well, the next 6 to 12 months is going to be almost entirely about the upcoming reality headset, right? Apple will be announcing this new mixed reality product, which uses both AR and VR. AR meaning that you can see your real world through the lenses, right? VR meaning you're all encompassed, all surrounded by your 3D content, right? So a mix of both. They're going to announce that product on June 5th, so in about 3 weeks from now at their developers conference. This is going to be their first major new product since the Apple Watch was announced almost 8 years ago, right? Or went on sale, I should say, 8 years ago. The product itself was announced in 2014. And so this is going to be one of Tim Cook's last big swings as CEO. And the company believes that this can set the foundation for a post-iPhone era, right? So all the talk is going to be about that headset for the next year or so, and the company hopes for many years beyond that.
So the difference between this and the watch, and a lot of people are making that comparison, Mark, because, the watch at first had kind of a lackluster take-up, but it wasn't nearly as clunky as this thing is. I mean, is it going to have a separate battery pack? Is it going to be a whole helmet or just the goggles? Is it going to be difficult to keep on your head? Can you walk around with it on? What's the story with this product?
So the goal is for this product to be as portable as possible, right? So this is going to be a standalone headset, all in one, as you mentioned, save for the battery. The battery will be external, right? It'll last about 2 to 3 hours per battery pack. You'll be able to swap those out if you want throughout the day, or charge over a connection to a power adapter. And the idea is you will be able to walk around with it, right? This is not something that you're necessarily going to it's not necessarily something you'll have to be stationary to use, right? The idea is that you could wear it in one room in your home or in your office, and let's say you're playing a game, right, in your living room, right? And so you're in your living room, it knows the game was being played in your living room. And then you walk to your kitchen, and it will open Safari, because the last time you were in your kitchen, you were browsing the web. So the headset has special sensors to know where you are in space, right? So you can pick up where you left off depending on where you were using the device in physical space. So to answer your question, yes, this is something you can walk around wearing, but not necessarily something that you're probably going to want to walk around wearing outside. It's funny, one demo internally, one presentation about the product talked about wearing this thing to a party, right? That's not something anyone is ever going to do.
I feel like the kind of person that wears this thing won't be invited to any parties.
There you go.
Hanging out in mom's basement is more likely. Dave Lee wrote an opinion column on this, suggesting that Apple aim at more to the Peloton crowd than the PlayStation crowd. What do you think about that, Mark? Because Apple has really embraced the healthcare market.
I think this product is going to take a scattershot approach. And so I don't think that's correct in terms of where they're going to market it towards. I think that they see this as a multi-purpose device that could do essentially whatever you want it to do, right? Like, so the iPad, right? You can do anything on the iPad, from making FaceTime calls to writing software to using software to playing games to watching movies. Everyone knows all the use cases you can have with an iPad. Same with every other Apple device, right? So I don't think they're cornering themselves in here. So there's going to be features for working out, probably coming next year. There's going to be meditation features, right? But there's also going to be movie watching, gaming, productivity, content consumption. One of the big ones is FaceTime. So FaceTiming in virtual reality using a virtual avatar that the device is able to create based on scanning your body with its 12 to 16 external cameras and sensors.
I hope it makes improvements.
Right, and that's going to be a core part of the product, as well as being able to work with people remotely and do co-presence and collaboration remotely, right? So me and you, right, in some universe, could both have this headset.
That's terrifying right there, but go ahead, Mark.
It's terrifying if Matt has the headset, but like, you know, he could be using the headset in New York, I could be using it in LA, and we can be working on a presentation together remotely while FaceTiming, all in virtual reality.
So Mark,
right? And I say could be, I'm not saying we'll want to.
Right. So Mark, I'm curious, like, what kind of product does this become in terms of, you know, revenue size? I'm looking at, right, iPhone revenue for the second quarter was what, over $51 billion. If I look at wearables, it was about an $8.76 billion business. I mean, how big a business are folks thinking that this could become for Apple?
So they're anticipating selling about 900K units in the first year, right, at a price point around $3,000. So in terms of revenue, you're talking about $3 billion per year. That's at the get-go. But the company does anticipate or hope that this becomes about the size of the Apple Watch or the iPad, right, at some point. And that could be a $20 to $30 billion a year annual business. Now, will that ever happen? I don't know, right? That's their hope. Those are their internal projections. But I am quite optimistic about this device. I think it's going to follow a similar trajectory to the Apple Watch, where at the get-go, the Apple Watch was sluggish. The app situation was, I would say, terrible. Still is, to be honest, actually. There was a lot of confusion about what the product was for. It was really all over the place. Apple actually pitched the first one. There were three things they pitched the first Apple Watch for: telling the time, health, as well as what they called intimate communication, sending your heartbeat to people, right? Nobody uses the Apple Watch to tell the time as a primary use case, right? I wear an Apple Watch, and I can tell you I only check the time on my phone still, right? Healthcare, they nailed. Yeah, okay, but this communication stuff nobody uses anyways, and they like
all right, don't judge Matt and me, but we both are saying, well, I use my iWatch to check the time.
I mean, we're twice Mark's age, but yeah, I use it. Like when I'm cooking, I have the timer right here, and I just bang. You know, 3 minutes aside of I'm frying some chicken steaks, and so that's probably the main thing I use it for, other than healthcare stuff, right? Tracking my sleep, tracking my heart rate, steps.
Checking text, though, it's a really cool. I don't know. I can see how it becomes a bigger part. Can I ask you something? I want to go back to how you started, though. Is this really Tim Cook's last hurrah, and do we need to start thinking about a Apple post Tim Cook already?
No and no. I don't think it's his last. It's one of his last. I think the last will probably be the car. And so, no, I'm not already thinking. Of course, actually, I am thinking about a post Tim Cook Apple, but this is not something that's going to happen in the near term, right? I mean, he's in his early 60s. Bob Iger is in his early 70s, and he's still at Disney. And you get the sense that they're built kind of similarly in terms of, you know, their desire to be part of the company, right? I would guess that if Tim Cook, you know, does eventually step down, or when Tim Cook eventually steps down, he'll probably still, you know, be on the board, or maybe they'll make him chairman or something, right?
And he'll come back after his successor fails?
Oh, I don't know if his successor will fail. I don't know who his successor for sure will be, but I think that I would just guess that Tim Cook would do a better job than Bob Iger in terms of planning out, you know, a succession plan there, right? I mean, it felt like the Bob Iger transition and his departure at the height of COVID, right, was extraordinarily abrupt. I would imagine that Apple's succession plan will not be as abrupt as
Who do you
the Disney
think,
one.
Mark? Who are the people in the running to be his successor?
Yeah, there's 4 people right now that I have my eye on. Number 1 is Jeff Williams. He's the COO. He's in charge of all the health initiatives, company-wide operations, and the design team reports to him now, and he led engineering for the Apple Watch, and he's quite intimately involved with this headset project as well. And he's essentially the chief decision maker on new products at Apple, right? And so he would be, if Tim Cook were to step down in the next 3 years, or if something were to happen, or they needed to do an emergency succession plan, you don't look further than Jeff Williams as the next CEO, right? A few other options on the executive team right now are Greg Joswiak. He's an Apple lifer, been there for 3 decades, head of marketing, head of product management, a real key player, probably a top 3 or 4 key player at Apple right now. Deirdre O'Brien, she's been at Apple also for over 3 decades. She's been in many roles across the company, from head of retail to head of human resources to senior executive on the operations team. She's also someone that I wouldn't be shocked if she were the new CEO. And then there's John Turnus. Yeah. John Turnus, he comes up because he's the youngest member of the Apple executive team. So if Tim Cook weren't to retire for 8 more years, you want someone a bit younger, and he's head of hardware engineering.
All right, Mark, love this. And I was so sure Matt was going to go into the Apple car, but I guess that'll be next
I'm
time.
waiting. I'm waiting
You're
to
waiting.
see what Mark comes up with.
All right, Mark Gurman, we love it. Chief Technology Correspondent at Bloomberg News. Thank you from our LA Bureau. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg with the Dow, the S&P, NASDAQ 100 index, all advancing a 1.1% gain or better. Right now for the S&P, we have got the Dow also up 1.1%, NASDAQ up 1.2%, NASDAQ 100 index also up by 1.2%. The stock market is climbing on speculation that a narrower group of Washington negotiators will break a deadlock on raising the debt ceiling. 10 years yielding 3.57%, with that 2-year 4.14% now. The S&P up 44 points, the Dow up 360, NASDAQ up 151, the S&P now at 41.54. Spot gold down 0.3%, 1983 the ounce, and West Texas Intermediate crude up 2.7%, 72.80 for a barrel of WTI. Target standing by its annual outlook after posting higher than expected profit in the first quarter. Target shares, they're advancing by 2.3%. Also after earnings, TJX up by about 0.7%. So how's the consumer holding up? Sarah Malik is Chief Investment Officer at Nuveen.
We are seeing signs of weakness with the consumer. They're dipping into their savings rates to spend, but however, they are still spending. I think going forward, the consumer will likely weaken. It's going to be dependent, though, on the employment market. As long as people feel comfortable in their jobs, they're likely to keep spending.
And among the names reporting today after the close of trading, Cisco Systems. Cisco up now by 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week. Carol Massar along with Matt Miller. You know Tim is on leave. So, okay, Matt, you know how we kind of constantly debate in our simulcasts, recession, no recession, what's the Fed going to do, cut rates, raise rates? Like we kind of go on and on, right?
It's like surveillance all day long.
It's like surveillance all day long. It's our favorite parlor game, is I think what Tom Keene often says. But on that, there's been a small group of economists who've been maintaining that the U.S. can indeed avoid a recession despite the most aggressive Fed tightening in decades. That group, by the way, starting to breathe a bit easier. It is among our most read stories on the Bloomberg. It's also a Business Week story. So let's get to it with Bloomberg News global economy reporter Enda Curran in our D.C. bureau. Enda, good to have you here with us. It's not easy being an economist that says no recession. Talk to us a little bit about that group and why they can maybe kind of calm down a little bit right now.
Yeah, so we're talking here about the true believers on Wall Street. We know the backdrop for the U.S. economy has been 5 odd percentage points of rate hikes in over a year. Economists saying the only way you can get inflation under control is to put a wrecking ball through the employment market and ultimately have a recession of some kind or another for the U.S. economy. But so far that hasn't panned out. There is a small group, some economists at Morgan Stanley, Goldman Sachs among them, who've been saying for some time now that actually this time really is different because the labor market is suffering.
But they don't want to say that, right? Nobody ever wants to say this time is really different, correct?
No, but they don't. But Jerome Powell himself came out and said it a few weeks ago when he was talking to reporters. So the point is, this group are clinging on the idea that the labour market has such a shortage of staff this time around that it's not like past downturns. Companies are holding on to staff. People are keeping their jobs. And that's one of the reasons why the US has so far avoided a recession. They're kind of standout calls. I mean, the broad consensus, you know well, throughout the cycle has been, look, inevitably there's going to have to be a downturn. But so far, the data is stacking up in the favor of the optimists.
And what do you look at to gauge the health of the U.S. consumers? I would think, you know, savings rates, bank balances, credit card debt, and when I put all that together, it's not a great picture. So what's your dashboard look like?
Certainly there's, I mean, as Ellen Zentner at Morgan Stanley said, the economy is flying pretty low to the ground. But let's look at two things. I mean, the jobs market itself is so tight. It's at the lowest level, at almost near a record low since the 60s. That's an extraordinary record by any economy. You have retail sales and corporate profits, broadly speaking, holding up. That means people have confidence to spend and companies are ticking over despite what's going on with interest rates. And I think most importantly, the housing market in the US, residential housing anyway, seems to have held up. Obviously, I'm relatively new to the US, but broadly speaking, there hasn't been a kind of a downturn that there was in past economic cycles, we'll say. And that's obviously one of the key sources of wealth for any house, for any family, is the price of their home. So there is, of course, the textbook reasons as to why the U.S. economy should be slowing down and probably will slow down. But you would have to say there's plenty of fodder there for reasons to defy the skeptics at this stage as well.
You know, one of the things we talk about a lot, Enda, is that this idea that we could have ultimately some kind of recession, but still have somewhat of a tight labor market. I'm curious how you factor that in.
Yeah, so then you get this whole story about the recession, as we say, it keeps getting pushed back, right? Every quarter or so, economists push it back. But let's say a recession does come along. Even then, there's a lot of division over what kind of a recession would it be. Would it be a deep one, as deep as the financial crisis, or would it be somewhat a shallow one and therefore less damage to the labour market? I mean, there's a view that the labour market is losing enough steam at the moment to try and get inflation off the boil, and this is where the whole immaculate disinflation story comes into it. There's another camp out there, by the way, the likes of Eddie Ardeni up in Boston, who's talking about rolling recession. He's saying some pockets of the economy are feeling pain, but the aggregate indicators will still show positive GDP. So there's
and we saw that in housing initially, right? We did see a little bit of a slowdown and things kind of...
And we see it in tech to some extent. You know, I've
with jobs,
talked to a number of 20s and 30s year-old kids who say they find it difficult to find jobs in tech right now.
Sure, and also, you know, when I said residential housing is holding up well, obviously the story is very different for commercial real estate. That certainly hasn't pulled out of the pandemic in the way that the housing sector has. So there are certainly pockets of pain. You know, the broad merchandise goods trade story has come off the boil as well with the switch to services. But the end story in all of this, or the bottom line in all of this, is that the recession narrative keeps changing. And as David Merkel at Goldman Sachs told us, it feels like we're on version 3.0 of the story at this stage.
So what's your take on people calling for the Fed to cut rates? JP Morgan Asset Management came out today and said they think the Fed's going to cut rates this year. I talked to an economist from NatWest Markets this morning, Michelle Girard. She said she thinks the Fed's going to cut rates, even though the Fed, I mean, Jerome Powell tells us pretty explicitly that they are not going to cut rates this year.
Yeah, I think you'd have to see core inflation come down further, Matt, really to much closer to the Fed's comfort zone. Even if it doesn't get to 2%, I think it has to come down well off that 5% purchase in and around at the moment.
It's got to be below 3, right? He said in so many meetings, it's got to come down closer to 2, closer to 2. And people ask, you know, for more specific numbers, but I think he implies it has to be under 3.
Yeah, that's probably fair. And a lot of people are saying, by the way, listen, this whole inflation era, we're going to have to get used to inflation settling at, you know, a higher level than it once would otherwise have been.
Right, but the Fed hasn't been willing to back off of that, right, and sticks to that 2% level. And one thing, though, I do wonder that if consumers, we keep talking about this, right, their household balance sheets, the Fed has put out different surveys, regional bank surveys, you know, that show that household balance sheets are doing just fine. So if consumers keep on spending, that's got to continue to put kind of inflationary pressures on the economy, which means the Fed is going to kind of have to keep either raising rates or leave them higher for longer. And ultimately, won't that at some point lead to a slowdown and some kind of recession? I mean, economies are cyclical.
Well, this is the flip side of the argument. When you have an economy doing, as broadly speaking, as well as the US is, well, that doesn't necessarily mean inflation will come off the boil in a hurry. Maybe we're getting into the harder yards now for the inflation story. Maybe the Fed has picked the low-hanging fruit. From here, it's going to get tougher. We have had some Fed officials out this week talking about the need for higher borrowing costs in the US. And then to your point, maybe this is where the theory goes that the US is only storing up even more trouble for itself down the road from here. The longer the economy stays strong, the higher inflation will stay, and then the harder the crash will be. That may well turn out to be true, but right here, right now, the true believers are clinging on to the data, which is certainly continuing to defy the doomsayers.
Hey, wait. Yeah. What? Wait,
well,
before
you were pointing at me, so I thought that meant...
No, I meant, hold
question.
on.
Oh, okay, I got it. Okay.
And one thing, though, I don't want you to go before, because I love what you wrote about generative AI and productivity, maybe solving the problem, right? I remember when Greenspan used to talk about productivity all the time and how that was, you know, how that helped out in terms of economic growth. Could AI ultimately, like I want generative AI to write my introductions for my show and help me out so I can do other things. Could that help us here?
Well, so obviously there's a whole series of threads with AI, but one of the talking points among economists is obviously what it might do to make us all more effective as workers and to improve our output. And the broad theory there is that the LLMs, the language learning machines, will boost, say, white-collar work, those in the clerical space, those who work in law firms, those who are doing cognitive work in universities, all of that. The idea is that those kind of applying that kind of technology will help their output and will improve what they're doing, drive innovation, help spur new ideas. This is the optimistic take. A survey came out of Brookings. I spoke to the academic Anton Korenik. He's one of the co-authors of it, and he said himself he's putting bullet points into his AI platform and he's getting turned out pretty good essays in return. His own productivity is up by 20% a week as a result. That's the hopeful take on it. We know productivity is very abstract, but it's so important to our economies. But obviously the downside of AI is what will it mean for people's jobs?
Could you imagine Matt on AI?
I just want AI to do my whole job. Read the news, be on TV,
Little Matt avatar.
I'll just stay home sipping slushies.
Oh, my goodness. And thank you so much. Really appreciate it, and certainly topical in terms of the big macro story here in the United States, and really globally. We're dealing with so many different issues. Enda Curran, he's global economy reporter at Bloomberg News in our bureau in D.C. What do you think about? You're still, wary about AI, this next level AI, aren't you?
No, I have a million use cases that I would love to see go into effect. I think.
So you think it's
AI
good?
Is really interesting. I don't necessarily think it's as much of a game changer for our jobs yet, but it could be fairly soon.
Could be. Could do our morning calls. Wouldn't that be sweet?
Well, it's going to put us out of a job if you keep wishing like that.
All right. Stay tuned. More to come on this. First up, let's get a check on world and national news. Off to D.C. and Nancy Lyons. Nance, take it away.
Thanks, Carol. President Biden is on his way to Japan, where he'll be meeting with G7 leaders. He leaves behind some unfinished work, though, on the debt ceiling. He believes the two sides will map out a deal.
I'm confident that we'll get the agreement on the budget, that America will not default. And every leader in the room understands the consequences if we fail to pay our bills. And it would be catastrophic for the American economy and the American people if we didn't pay our bills.
Biden says he'll be in constant contact with White House officials while he's in Japan. He has scheduled a news conference for Sunday when he returns from the summit. The two sides seem at odds over proposed work requirements and some who receive government aid and how deeply to cut the budget. The Supreme Court has left in place a new Illinois ban on the sale of semi-automatic assault-style rifles while legal challenges move forward. Today, the court turned away an emergency request by a gun rights group to pause that law. Well, they say 2 out of 3 ain't bad, but in this case, when it comes to the global climate, it very well could be.
The World Meteorological Association now says there's a 2 in 3 chance the world reaches the danger zone on global warming within the next 5 years. It's the first time the UN's weather agency has said it's more likely than not there will be a year that's 1.5 degrees Celsius hotter than pre-industrial times. The report says warmer than normal Pacific waters from El Nino will develop in the coming months. That, combined with greenhouse gas emissions, could put the world past the threshold set in the Paris Climate Agreement. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, and NASDAQ all advancing amid cautious optimism for a bipartisan debt accord. Let's get the latest now from the breaking news desk as we say good afternoon to Bill Maloney.
And good afternoon, Charlie. U.S. stocks with a bid today helped by those regional banks. Dow's currently up 357 points. S&P's gained 43, and NASDAQ is higher by 145. The U.S. 10-year yield at 3.57%. Gold is down 5. Oil trading in the green, and Bitcoin is higher by 0.8%. Among the main 11 S&P sectors, leaders were energy and consumer discretionary. Only utilities and consumer staples were in the red. And leaders to the upside in the Dow, Boeing and Home Depot, while Merck fell 1.3% and led to the downside. After earnings, Target rose 2.5%. And in other news, McCarthy says getting a debt limit deal done this week is doable. And wrapping things up, Cisco reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. We'll be all over Cisco when it breaks, and to hear live breaking news over at your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just under 18 minutes left in today's trading session. We've got a rally underway. We've got each of the major equity averages, as you heard from Charlie, up more than 1% here. So we're hovering just off our best levels of the session. Quick check on what we're doing in terms of the Treasury curve. We've got that 2-year yield at 4.14, looking out a little bit, 10-year at 3.57. So let's get to it. Let's talk a little bit about what's going on in the markets further with Jake Jolly. He's head of investment analysis at BNY Mellon Investment Management, joining Matt and me in our Bloomberg Interactive Brokers studio. Jake, good to have you here. You look at this environment, and how do you explain it to some of your clients?
It's tough, is the short
That's
answer.
fair.
Look, there's still a lot of uncertainty out there. The data is definitely still pretty mixed, right? Things look a little bit better on the services side, manufacturing, not so much. Obviously, throw in the mix the debt ceiling. That's obviously, I think, a bit of dampening sentiment. Not today, apparently.
Right.
But we think that the bigger story here is that there are a lot better investment opportunities this year than there were last year. So as much as I think that the outlook is still unclear and maybe a little bit worrying, but
it was really lousy for bonds and stocks last year.
It was.
So I hope it's a little bit better.
And that's one of the silver lining of the fact that it was such a bad year for bonds is that this year just looks much better, right? We have yields that we haven't had in more than a decade. So in terms of the opportunity to get into high quality fixed income, we think it's a really great time. And to that point, in terms of one of the questions that I get from clients a lot is when is the time to extend duration? Because obviously there's a lot of people sitting in cash and cash-like bonds. We think that time is now. So when we look through history, when you are close to that peak in the Fed's hiking cycle, that's historically a very good entry point because thereafter you tend to see yields move lower. So we think that that's very likely going forward. And in terms of getting in at a rate that is very attractive that you can lock in for a few years, it certainly seems like a good time.
So like 20-year treasuries right
out.
now yielding almost 4%. Is like an attractive yield that you're watching? And do you think there's going to be any kind of capital appreciation there? Or
Yeah, and that's one of the things that we always have to remind people, I think, after the 2010s is kind of go back to bond math, right? We didn't have the kind of income return that we are going to get on investments in bond portfolios right now. I'm not sure you necessarily need to go out to 20 years. I think you can probably stay in the intermediate space and find some good opportunities. But
I'm just talking about govies, right? Because there you just don't get a decent yield or a comparable yield unless you go to 20s. The 10s are at 3.5. So are the 7s and 5s, right? So either you're in 2 months to 2 years, or you're in 20 years to 30 years. But you're talking about IG debt.
Yeah, I am. I mean, we like sovereigns, we like high grade or high quality investment grade, and I think one reason to not say go way out the curve is that there's probably a pretty nice sweet spot in terms of your duration exposure in intermediate space. You're mentioning that there is a bit of a upward sloping curve from sort of that intermediate out to 20. It's not terribly steep, and if you can sort of stick in the intermediate space, you have a bit more optionality. Obviously, locking in for a couple years is good. The real big story here to us is that we think that there's significant investment risk at the short end of the curve. So folks that are getting a bit too comfortable in sort of the 3 months, 6 months, those kind of rates, we don't think that those are going to stick around. And we think that that's why, a good time to start shifting out the curve.
Do you also, I mean, again, we go back to something Matt and I talked about earlier. Do you think that the Fed, or you guys, your thesis in terms of the investment outlook and Fed outlook, that the Fed will cut rates this year?
So that's the thing. You really don't need
You
rates.
don't care.
Yeah, it's sort of not critical to the thesis of bonds performing well because, number one, the income component is going to be very strong. Even when rates peak, you generally start to see yields move lower, right? Because the market is going to, we're already seeing the market pricing in those cuts. We don't think they're likely to come this year. But again, in terms of, getting that total return from bond portfolios, you don't need the cuts. And that's kind of getting back to what I was saying in the 2010s. We have to relearn bond math a little bit because we're dealing with a yield environment that is just much different than the 2010s. We're not sitting at the zero lower bound. We don't think we're going to be sitting at the zero lower bound anytime soon, which means that income component is just much more attractive. So you have to compare that against other investment opportunities
And
out
you
there.
do like bonds better than equities right now. How do you tell investors to buy these? Do you like ETFs? Or funds? I mean, what's the best wrapper? Or do you want to go and find an actual corporate bond to purchase?
Yeah, well, the answer you're not going to like is it depends on the investor. People with different circumstances, different investors have different needs, different preferences for liquidity. What they can get in different wrappers might be slightly different too. So, unfortunately, the answer is it really depends. And maybe the short answer is that's what financial advisors are for.
If you're looking over the next year or two, do you feel some confidence about where the environment goes? Where would you suggest folks place it?
Well, like I said, we think that sovereigns look attractive. We think that within high quality investment grade,
are there certain sectors within the investment grade space that you like?
Well,
companies?
I think some that are likely to be more durable going through a period of slowdown. So you might look to aerospace, you might look to pipelines, things that are likely to not be tested as significantly during a recession, because we do think that odds are in favor of a recession. Well, I shouldn't say favor. Nobody wants a recession, but we think that at the end of a tightening cycle this aggressive, that it is more likely than not. That kind of going back to your first question of why is this a difficult market to talk about? Well, it's because we've been kind of sitting in this very tight trading range. The market doesn't really have direction. I would kind of put it in we're sitting in between kind of the upside and downside scenarios, but we're definitely not pricing in the downside. So that's why, on the whole, we think, favoring quality names, not just within equities, but within your bond portfolios as well.
The reason I ask about ETFs is because I see quant all over your resume, right? I see systematic investing. I see that you are focused on factor investing. So it seems to me that you would be interested in like buffer ETFs, but we don't have enough time for that.
Well, can you do something in 20 seconds?
Sure.
Say it. Go.
Well, the key factor during recessions is quality. Now, quality as a factor is kind of a hand-wavy term, but at the end of the day, it's profitability. So it's those names that have stronger ROE, less leverage.
Go for the top tier.
Exactly.
All right,
that's the short answer.
Got to run. You did it though, with a few seconds to
like
spare. Jake Jolly, head of investment and analysis at BNY Mellon Investment Management, here in studio. Thanks so much. Appreciate it. All right, you're listening and watching Bloomberg Business Week.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 7 minutes to go ahead of the closing bell, and among the names that will be reporting after the close of trading, Cisco Systems. Right now, Cisco shares up 1.7%. That report will highlight the state of the tech infrastructure demand. Also, tomorrow we'll be hearing from Applied Materials ahead of that report. Applied Materials up now by 4.1%. Shares of regional banks rallied after Western Alliance Bancorp said deposits had grown by more than $2 billion since the end of the quarter, easing worries about the health of U.S. regional lenders. Right now, shares of shares of WAL, Western Alliance Bancorp, up by 10.8%, PacWest up 21%, and Zions Bancorp surging 12%. The KBW Bank Index up now by 5%. As for the overall banking backdrop, is the worst behind us? That question today from Michael Cugino, President and Portfolio Manager at the Permanent Portfolio Family of Funds.
I would say the banking environment is currently quiet. Whether it's over or not, we don't know. I think the risks of a couple months ago have receded, no question. But we don't know if there's other problems out there that just haven't been discovered yet. And I think the more you raise interest rates, the more stress you put on the economy through rising rates, the more likely you could have additional scenarios. But it would appear to be a receding risk at the moment.
And those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. Carol Masser with Matt Miller here in our Interactive Brokers studio. Would you like to join Monaco's richest 1%? Are you there maybe already?
I mean, I would like to have that much money, but I don't think I would be in Monaco except for when it's Formula One weekend.
What do you mean? Why not? Monaco's lovely.
I just feel like there are other places I'd rather be, you know?
A 1%er or just in general?
A 1%er would be fine, you know, but I would be probably more in the mountains than on a yacht. That's just my...
Well, there's a great story by Ben Stupples on the terminal, and it says if you want to be a 1%er in global wealth, it takes $12.4 million to make the cut in Monaco.
Oh, well, I'm going to fail then on that.
Okay.
On that count.
Let's see. How about Switzerland and Australia?
That doesn't seem like that much, though, does it?
It doesn't. I mean, forgive me. All right, everybody, if you want to be mad at me, it doesn't seem like that.
I mean, I don't have $12 million, but I feel like that is that the limit? Is that all you need to be in the top 1%?
I guess so. That's according to Knight Frank, where billionaire residents such as UK industrialist Jim Ratcliffe and Walgreens Boots Alliance chairman Stefano Pessina typically don't face income or capital gains taxes.
So, okay, that's a good reason to be in Monaco.
There's a sweet spot.
But the thing is, a billionaire still has a heck of a lot more money than $12 million.
Right, but
there's a huge... Well, that's a chasm between 12 million and a billion, right?
That's not even, like, how many standard deviations?
Exactly. That's what I was just going to try and figure out on the calculator, but I don't even have the energy to do that.
Switzerland and Australia have the next highest entry points to the 1%, requiring a net worth of $6.6 million and $5.5 million, respectively.
I'd go to Switzerland. So there's a country that's gotten it right. You know, the top income tax rate is 15%. That's the ceiling. Doesn't go higher than that. And guess what? Their country runs really well, and they take care of their people, and they have a fantastic social safety net, but they don't tax anyone more than 15% on income.
But there's a lot of money there. So if you do
that's true.
If you do 15% of really big numbers.
Yes, you're right.
Okay, so it's
but they also, I feel like they manage their money better. They don't have the ridiculous politics that this country does.
In the Philippines, if you want to join the 1%, guess what? Guess how much you need? Quickly.
In the Philippines, I'm going to say $5 million.
$57,000.
Okay, I was off by
a
few standard deviations.
Over to the TV team we go. Our simulcast. We're talking about the markets beyond the bell. It starts right now.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Bonnie Quinn. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Matt Miller. Welcome to our audiences across Bloomberg Television, radio, originals, and those folks streaming on YouTube. We opened in the green, and we've been moving higher ever since, Carol, in equity markets, a sell-off in treasuries, and some of this optimism now rubbing off in the commodity space as well. An interesting rally going on in crude oil as well.
Yeah, it's pretty impressive. And if you want to see some outperformance, check out the semiconductor area. The Philadelphia Semiconductor Index, it's up about 2.5% as we speak, Matt. So again, we're seeing some enthusiasm, a lot of investors kind of reaching out and branching out when it comes to a lot of sectors in the equity market.
Yeah, absolutely. It was difficult, I will say, to find any decliners with decent reasons. You know, the only place that I have to look right now is earnings, really, and there are only a few companies left in the S&P 500. We have an earnings recession pretty much confirmed now, but that doesn't seem
There's
to...
120 names to the downside in the S&P 500.
Yeah, no, but I mean with any big reason, right? If you look at the S&P 500, so I'll just, if you want, I can just throw a few at you.
Not now,
hey,
later.
Why is Illumina down? Why is Aon selling off? I mean, I dealt with this in the stocks reporter. There just isn't really a great reason.
Nah, I'm tapping out on this right now. As you know, Carol, I'm a little under the weather, but I pushed through here. I do want to point out, we're going to get the closing bells here in New York, and as we take a look there, Waste Connections ringing the bell at the New York Stock Exchange. We should point out, too, you know, I'm a sucker for history, and we go back to sort of the big sort of compromise of 1790 that effectively kind of solidified what Wall Street is. And then, of course, back on May 17th, 1792, you had a bunch of stockbrokers get together, 24 to be specifically, that really set the rules for what our market would be, set the conditions for what it would be, and that is the official birthday of the New York Stock Exchange here, 1792 to today here in 2023. And it is an update here, so something to celebrate with the S&P 500 higher by about 49 points or 1% on the day. The Dow Jones Industrial Average up more than 400 points or 1.2% on the day, while the NASDAQ Composite is going to finish the day higher by about 1.3%. Your outperformers, though, you saw that in a lot of the bank stocks. You saw that in a lot of the cyclicals. The Russell 2000 up 2.2%.
Yeah. All right. And speaking of some outperformance, check out the KBW Bank Index. I mean, that index is up about 5% in today's session. We've talked about the regionals really outperforming, but and I know, Ronnie, you mentioned it earlier, really financials on a tear today.
Exactly, and they ended the day the best performing group in the S&P 500. For a time, that was the airlines, but the financials weren't going to have it. They wanted to be up top, so regionals, mainly, as you say, components of the KBW Bank Index, that as a group up 6.3%. Airlines, though, coming a close second, up 5.5%. This, as we hear, at least, from IATA, that there's going to be a lot more trips, 35% more between May and September than there were in 2022. And, of course, Matt's going to tell us why the reinsurers are some of the worst performers today.
Well, you know, I don't know why they're the worst performers as a group. I do know why Everest Re, one of the reinsurers, is falling, because I looked on the ticker and I saw a statement that they're issuing 3 million shares in a secondary offering. That adds to the 39 million shares about that they have outstanding. They're trying to raise money for general corporate purposes.
I'm just going to, sorry, one second, Matt. I am going to interrupt you here. There's some breaking news here. This involving the Treasury's cash balance, of course, something that we've all been paying a lot of attention to. That cash balance ticking up just a little bit here on May 16th as of yesterday to $94.6 billion. Remember, there was a lot of talk here about what it had dropped to the day before here, one of the lowest levels that we've seen in such time here. Of course, the cash balance is effectively the fund that the Treasury has in order to pay its bills, if you will. Obviously, there's tax receipts coming in over the next few days and weeks that should actually boost that a little bit further. So maybe that changes the X state just a little bit, if only by a day or two, but of course, something we're all keeping an eye on.
Right, and it still needs to get done, no doubt about it, even if the deadline changes by a day or two. Hey, let's get back to some of the movers specifically in today's trade to the upside. And we're going to go back to the banking sector because Comerica was #1 in the S&P 500. This one pretty much holding on to all of its gains for the days, finishing up about 12.5%. We know the regionals were up. Western Alliance talking about deposit growth at the end of the quarter. So we really saw a whole boost in terms of the overall banking sector and regionals in particular. The KBW Regional Bank Index, by the way, up more than 7% at its close, most in 2 years. So generally, that whole sector up. Want to also mention, I talked about semiconductors. They also saw some outperformance today. AMAT among them. That went up almost 4% in today's session. This company added to Jefferies' franchise picks list of top conviction buy rated stocks with a price target of $140. The stock closing just below 126. Keep in mind it does report on Thursday, and it's up about 30% year to date. And one more for you, Tesla, number 2 in the S&P 500. In the NASDAQ 100. It was a top buy among banks last quarter. We know there was a bunch of headlines after the close yesterday, a CNBC interview, and also the meeting that they held. But nonetheless, Tesla and outperformance today up about 4.5%, Matt.
And Tesla is adding the second most points to the S&P 500 at the close. So in that sense, it is number 2 on the S&P 500. In terms of the losers, as I said, we have a lot of stocks, Carol mentioned, 120 down. Not a lot of specific reasons for them. Everest Re, to answer Bonnie's question, is selling shares. EVgo is another company, not on the S&P 500, but it is also selling shares, and that's why that stock is down right now. They are selling $125 million worth of new shares. They have an $18 million green shoe, and they're going to expand their charging network with those proceeds. And then WeWork is falling as well. I bring it up because it's famous. Mizuho is downgrading it to a neutral, which is a polite way, I think, of selling. They no longer want to own it. From a buy, they slashed their price target to a Wall Street low of 30 cents a share. WeWork, as a company, is now worth a total of $561 million in market cap.
Isn't that amazing? It's not 81%
very little.
this year. Yeah.
A lot of activity, of course, outside the world of equities. We saw a lot of activity in commodities as well as in the treasury space, and cheapening pretty much all across the curve here on the day. That's pushing yields higher on the 2-year yield by about 7%, back up to about 4.1498 if you want to be precise. And we're up about 4 basis points on the 10-year yield. So we talk about the bear flattening that we're starting to see here, and whether that's a commentary on economic conditions or maybe more of a commentary of that rotation, I guess, out of some of the safety that some folks had flocked to over the last few days and weeks, and into, I guess, something a little bit more risky as we wait for earnings to cross the wire right now. We are getting Cisco earnings right now. Let's get right to that for their fiscal third quarter numbers coming in right now. On an adjusted basis, EPS is a beat, $1 per share. The street was looking on average for 97 cents per share. Gross margin in the quarter also above estimates at 65.2%, and revenue for the quarter coming in at right around actually, I'm not seeing that revenue number. Forgive me here. So let's say at $14.6 billion, which was a beat. Let's go to the forecast here. Looking forward here on a full year basis, the company is saying that it does plan to have a range of about 380 to 382 on adjusted EPS. That is above the top and bottom line of what the street was looking for as well. And their revenue guidance for the full year is growth of about 10 to 10.5%, and that's above its most recent range that it had given of 9 to 10.5%.
And it's maintaining its quarterly dividend at 39 cents. The stock jumping in the after-hours trade and holding onto those gains now up about 1.4%. Seeing full-year revenue, by the way, which is probably the thing that analysts are most looking for in terms of forecasting, at plus 10 to 10.5%, which is much better than the 9 to 10.5%, or at least it's a narrower range in the better direction, let's say, Carol.
All right, so let's get to Take-Two, because they're also out with their earnings, and we see the stock initially popping down in the after hours. Stock's up about 20% this year, but take a look at fourth quarter adjusted EPS, 59 cents a share, folks. That is a miss, 9 cents light of what the street was expecting. Fourth quarter net bookings, 1.39 billion. That was a little bit better than what the street was forecasting. They were looking for an estimate of 1.34 billion. First quarter adjusted EPS, 24 to 34 cents. That's your outlook. The estimate is 80 cents, so that looks like a big miss, but we'll look for some clarification on that. Fourth quarter adjusted EBITDA, going back to the fourth quarter, 169.8 million, Matt. That's a little bit light, 193.8. And then talking about 2024 net bookings, 5.45 billion to 5.55. That's light, folks. The estimate is 5.89 billion, but nonetheless, stock up 4% in the aftermarket.
Dude, you can only play so much GTA, right?
Is that true?
Red Dead Redemption, after 18 hours, just gets a little bit old, and if we're not in the lockdown mode, I don't know who's going to be sitting on these Take-Two games. Romaine, I feel like you should, though, maybe spend a few hours at home playing games, drinking some hot tea. If you lose your voice, you're no good to us.
Yeah, well, Matt, I spend all day just yelling at Matt in the dressing room. So, but
do you really?
I try. No, I'm joking. I'm joking. I do that to Carol, actually, which is really awkward.
That's very true.
But in all seriousness, I do want to just, sorry, before we break, guys, I do want to just go back to the Cisco earnings, because a lot of folks were kind of looking at this as kind of the big tech laggard, right? You had this big, massive rally in the NASDAQ 100 to start the year, 20-something%, and Cisco really wasn't a part of that, right? But they surprised in the previous quarter that they reported. This one isn't as much of a surprise, but the idea that investors do seem to finally be embracing the turnaround efforts there, and the idea that there is life in, I guess, a legacy tech company, if you will, if we can call them that, maybe that's an encouraging sign that maybe there are some legs to that broader tech rally.
Well, and it's the backbone of so much. And they also, in a press release, I know we got to run, but they also do talk about some key technologies like cloud and AI. So they're touching on that as well. Hey, have you heard of it?
Carol's obsessed. No, explain it to me, please.
I am obsessed.
I haven't heard anything about it.
It's going to replace me.
Yeah.
And then I can go like vacation or do something. I don't know. All right, guys.
Which is the unemployment line.
Or that,
exactly.
That too. All right. All right, that's a wrap on this Wednesday. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. Beyond the Bell is what we call it. We will see you again, same time, same place tomorrow.
Whenever you go shopping, to buy a dress that's new, honey, I'll keep my eye on the dresses you try on, 'cause I'm going shopping with you.
All right, so we had a little bit of earnings in the tech world and the video gaming world, but we want to get back to what's really been dominant in the earnings space this week, and that is the retail world. And we've got a great voice to walk us through the earnings we've gotten so far, the earnings still to come this week and next week. With us is Dana Telsey. She's founder and CEO of Telsey Advisory Group, a top-ranked equity research analyst covering all things retail, and she has for a while and has such a great perspective. She's with us on Zoom in New York City. Hey, Dana, so nice to have you here with Matt and myself. First of all, we have gotten some earnings. We got TJX out, Target. We had Home Depot yesterday, Walmart to come tomorrow. So far, is there a broad theme? And I know not all retail is the same, so maybe that's an unfair question, but how are you seeing the results so far?
Oh, still mute. First of all, thank you so much for having me. Absolutely thrilled to be here. And yes, in terms of retail, we've gotten some results so far. I'd say the puts and takes. Bottom line is discretionary spending is still soft, and it's soft almost across the board. I'd say that traffic in stores has picked up. That was good to hear about both from Target and from TJX. The focus on value is definitely key. And we're seeing the continued strength of essentials stronger than discretionary. I'd say what I worry about overall is that for some of the companies that have reported, it certainly seems as if they beat the first quarter, they're adjusting the second quarter a little bit lower, and expecting the back half of the year to be a big uptick. And that's the big question mark, with the concerns about rising inflation, rising interest rates, and frankly, maybe it's moderating inflation, but are consumers spending more on experiences or services than they're spending on goods? I'd say so far it seems like TJX was one of the best results out there, given the fact that the traffic was up, their inventories is definitely being managed well, and they saw apparel and accessories do well. I thought that Tapestry's numbers also had been very good too, given the strength that they've seen in the continued AUR increases, and frankly, the continued strength of physical. So bottom line is that lower to middle income consumer is still cautious. I think there's greater spend on experiences than goods. The fact where there are goods spending, it definitely is on essentials. And the moderation of discretionary is coming at all income levels. We're fortunate that the balance sheets of these companies happen to be pretty solid.
You mentioned AUR, so we're talking about average unit retail, just for those listening. Matt, in case you were wondering.
You know, I think exactly what you were saying about the pattern these companies are following is how I see Target. And I was telling Carol before the show kicked off, this is something they might regret. They're going to have to cut their forecast down the road, because yes, they had a good Q1 and now they're in the middle of a soft Q2, and I guess they're taking a gamble with holding their forecast steady. And that could come home, could come back and bite them in the end, right? I mean, I'm looking right now, Dana, at U.S. credit card debt, and I've maxed out the chart. It's the highest that it's ever been. Meanwhile, the savings rate has dropped substantially, and I can't get the bank balances up on my terminal, but I'm suspecting that they come down.
Yep. That's the concern. I mean, the concern is a hockey stick of 2023 going to be realistic when the initial expectations for holiday 2023 is not going to be as great as it was in holiday 22. The two offsets are the fact that we have reduced supply chain costs, lower ocean rates, using less air. So that's one element. And the second element is inventory is lighter. So inventory is lighter, there's more flexibility with retailers focused on chasing into demand when the demand arrives. And that's what we're all going to be watching very carefully as we head into the third quarter.
You know, we haven't even talked about kind of department stores and stuff. How do you think about them, Dana?
It's going to be very interesting. Dillard's obviously reported last week, and one of the commentaries that Dillard said, which is meaningful for everyone, is the fact that consumer activity decelerated in the back half of the quarter. So that means that back half of the quarter, basically at least the month of April. And we heard that March was weak, and so now to say April is weak too, that's a concern. If you have to say the department stores, I worry about Kohl's, I worry about Nordstrom. It seems like Macy's, with the strategy that they have in place with Polaris, and basically modernizing the department store, they've really been at the forefront of enhancing change. And I feel like some of their results may be a little bit better than what we see in some of the others.
All right. By the way, like on cue, John Authors just sent me a chart of U.S. bank balances.
Oh, did he really?
They're still very strong. So to me, it's a puzzle. I mean, they've come down.
The Fed has come out with
numbers. They've come down a little bit, but they're still very strong. And then I wonder, why are consumers putting so much on plastic? Dana, do you know why we're utilizing credit cards, you know, at the highest pace that we have in at least 10 years?
Well, in the near term, the savings rate has come down a little bit, and you are seeing people spending more on travel and experiences. Typically, that spend goes on credit cards.
Good point. Good point. That is a good point.
All right, so when you look at the outlook here, if you had to say, and I'm thinking about the Bloomberg investor audience, who are the most vulnerable as we look at the kind of second half of the year into 2024, and who are the best positioned, Dana?
Well, keep in mind, we still have the majority of retailers yet to report their earnings and hear what the update to their guidance is. When we know in terms of who's been having challenges to begin with, you're definitely watching some of those department stores like a Nordstrom and like a Kohl's. I think you're definitely continuing to watch some of the specialty retailers, for example, and watching how Gap maneuvers through the changes that they're having, given they're still searching for a new CEO.
Walmart. We didn't even touch on Walmart.
True. Coming out tomorrow before the bell. Yeah.
What should we keep on our radar?
I mean, given that we had Target with a better than expected first quarter, and we know that Walmart is so essentials focused, it almost feels as if we should have some decent results out of Walmart while looking towards what they're expecting for the second quarter and the back half of the year. They do have more international exposure. Everything we've heard about international lately has been good. You take a look at what TJX reported, both on Canada and on international, and it was strength.
If those, if we do go into a recession and it's deep enough to really feel it, which are the stores that benefit the most from, consumers stepping down? I can no longer afford to go to, I don't know, the neighborhood Target. So do I drive out to Costco instead?
It could be Costco, it's the dollar stores, it's the off-pricers, and it's the discounters. So it could be your Walmart and Target, your Dollar General and Dollar Tree and Five Below. It is Costco, and it's also TJX, Ross stores in Burlington.
Auto sales were very strong in April. I was really surprised by how much Americans are willing to spend to buy new cars. Is that the last hurrah for the automakers?
May not be. I mean, you're certainly continuing to see the new enhancements and the new deals, and we know what consumers are focused on. And if they're going to be traveling, how are they going to get there? We know what with Memorial Day weekend comes what that means to travel.
Hey, just got 25 seconds left. I wanted to squeeze in, Matt, initially on our morning call was talking about Watches of Switzerland Group, the top seller of Rolex timepieces. What is, in 20 seconds, Dana, the thought about high-end versus low-end?
High-end's moderating also. We've seen a moderation in high-end. We need some of the foreign travelers and tourists to come over here. So there's a moderation at the high-end too.
All right.
I also think Rolex is maybe its own story. It's a very special story.
It is a special story. More to, actually, Bloomberg Businessweek Pursuits has covered a lot in terms of watches.
And Andy
stuff.
Hoffman is our definitive voice on Rolex
All right,
watches.
so maybe we'll do more. But Dana is the definitive on retail. Dana Telsey of Telsey Advisory. Thank you.
2合1包饺子神器，给大家找。
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. It was an up day on Wall Street, but after the bell, lots of earnings. Among those coming in right now, Take-Two Interactive Software, the stock rallying after ours. Take-Two up now by 10.6%. Moments ago, we heard from Cisco Systems. That stock is trading lower now by about 0.8%. Cisco, the largest maker of machines that run computer networks and the internet, it did deliver a strong sales forecast for the current quarter. lower, indicating some customers remain committed to upgrading their corporate technology infrastructure. Cisco, however, lower after hours, down now by about 0.8%. As I mentioned, an update, stocks climbed on speculation that a narrower group of Washington negotiators will break a deadlock on raising the debt ceiling. S&P up 49, up 1.2%. The Dow today up 408, a gain of 1.2%. NASDAQ up 157, a gain there of 1.3%. 10-year yield at 3.57% with a 2-year 4.15%. Gold 1982 the ounce, down 0.3%. And West Texas Intermediate crude oil up 2.6%, 72.72 a barrel. Earlier today, we heard from retailers Target and TJX, a parent of Home Goods and Marshalls. Target up today by 2.6%, TJX up 0.9%. As for the broader retail picture, Dana Telsey is the founder of Telsey Advisory Group. She was interviewed moments ago right here on Bloomberg Business Week.
Bottom line is discretionary spending is still soft, and it's soft almost across the board. I'd say that traffic in stores has picked up. That was good to hear about both from Target and from TJX. The focus on value is definitely key. And we're seeing the continued strength of essentials stronger than discretionary.
And again, revisiting Cisco Systems after hours, the stock now down by 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Carol Massar, along with Matt Miller. Tim, you know, on leave. You are listening and watching Bloomberg Business Week here in our Bloomberg Interactive Broker Studio on YouTube and Bloomberg Originals. Hey, I don't know if you saw this, Matt. Last month, Bloomberg News putting out a story reporting that an international developer backed by Tiger Woods and Justin Timberlake were joining an effort to build a sprawling residential community with stores and a revamped golf course in Wellington. It's a South Florida equestrian town near Palm Beach. It's also, Wellington has been, I guess, home to Microsoft co-founder Bill Gates.
Yeah,
also
I've heard of it.
Tommy Lee Jones, Bruce Springsteen.
Tommy Lee Jones, the actor.
That's the actor. They've owned homes there, apparently. I don't know if they still do, but they have.
That is interesting.
It's kind of shishi.
I guess so. I'm not really a South Florida guy. I like the Keys, you know.
Palm Beach, kind of nice.
Yeah, it's okay. I've been there.
Okay.
You know, stayed at the Breakers, did the whole golf thing.
Kind of a New Yorky kind of person.
Yeah, it was pretty good. I mean, if I have vacation time, I'm going to go somewhere different.
Okay.
If I want to go to the beach,
this is about
I want
living,
to go to a secluded beach. If I want to move somewhere, like, you know, I would rather have the mountains. I'm more of a Montana person, you know?
Yeah, I have seen you wear a cowboy hat.
Yeah.
Occasionally around. Cowboy boots. Do you have cowboy boots?
I have a few pairs of cowboy. Every time I go to Dallas, you know,
you pick up
I tend to buy a pair. My goddaughter lives in Dallas, so I go there occasionally. I like to go watch the Giants play the Cowboys.
We want to talk South Florida with someone who knows a lot about what's going on when it comes to South Florida real estate. Daniel De La Vega, president of One Sotheby's International Realty, joins us on Zoom from Miami. Daniel, good to be talking with you, and great to have you here with Matt and myself. Hey, talk to us a little bit about South Florida and what's going on. What are we seeing in terms of prices and valuations?
You know, South Florida's in an incredible place right now. First quarter was incredible. I want to talk about the numbers. I want to give you all the information that the viewers want. But first, Matt, what a segue into talking about South Florida. We got to get you down here. Maybe you have not experienced it with me yet. So
I think, you know, part of it, Daniel, is
a place that you love.
I'm a little bit bitter because, to be honest, a lot of my friends from the Upper West Side, previously from the Upper West Side of New York City, are now living down in West Palm Beach. And it's like one after the other, and now it's like I don't know anyone else up here.
Yeah, I mean, listen, we're representing Pier 66 in Fort Lauderdale, which is Tavistock Development Group, which you previously mentioned in regards to the development in Wellington. And that is just the epitome of South Florida, living with a marina, with a hotel, with residences. So they do a really, really great job. And I'm sure Wellington is going to be spectacular as well. But look, South Florida is doing incredibly well, guys.
All right, you keep saying, give us some numbers because you keep saying incredible.
We saw a major increase in closed sales, average sales price, new pending sales, months of inventory, yes, is up, but in closed sales in all of South Florida, Q4 22 over Q1, we saw a 14.7% increase. Average sales price, we saw a 6.6% increase. New pending sales are up 66%. I mean, that's an incredible statistic, right? And again, months of inventory in both single-family homes and condominiums are up on average 20%. So that's good, because as we see people moving to South Florida, we want them to feel like it's an affordable place for them to live. So as I see the increase in inventory as a positive for our market.
I mean, one of my best friends is I won't say his name, but a Morgan Stanley guy. He was up here, now he's moved down there. His office is, he says, just a couple of blocks away from his place in West Palm Beach. And he says the restaurants and the bars that he and his, clique know and love from up here all operate down there as well. So is it really just like a slice of Manhattan, in Florida?
Yeah, I mean, look, we've always said Manhattan South, but I think we're becoming Manhattan more and more. I mean, we had 130 new companies move to Miami alone. We had 12% of the 5.8 million new business application filed nationally happen in the state of Florida. A lot of that happening in South Florida. You just heard the numbers for Miami. So look, we've got 1,217 people moving here a day. I don't see those numbers slowing down. And to your point, right, it's not just the jobs that are moving, it's the families that are moving. And we've seen a new influx of the kind of person that moves here. I mean, traditionally we saw flight capital, we saw a lot of Latin America. We're seeing 50% more domestic now over the last, call it 24 months. So it's people moving here to live here. So they want those things that you're talking about, Matt, and we're delivering them. I mean, look, just in West Palm, I had lunch at the bar at Felicia, an incredible restaurant. It's a sister restaurant to St. Ambrose. So everybody's thinking creatively how they can bring new brands to our market.
Daniel, how much of it is finance and financial types that are moving there?
80% of our transactions are cash. That was happening during the pandemic, and we're still seeing that happen now.
No. I mean, how much of it is people from the financial sector? Because we've done those stories a lot. How much? That's okay. That's okay.
Yeah, it's I would say it's about 50%. 50% of the people moving to South Florida from the sector. Yeah.
It really is. Like Wall Street has moved down. Not just New York, right? But Chicago is one of the big Citadel offices. Ken Griffin's company moving down there. Is it just pushing property values up in the surrounding communities as well? I imagine, I'm from a small town in Ohio, Granville, right outside of Columbus. Intel built a factory near us, and all of a sudden, everybody's property values have doubled. Do you see that as well down there?
Yeah, it's the same here. And it's the secondary and tertiary markets as well within South Florida, not just the waterfront, ultra luxury markets. We have to deal with affordability. We are dealing with it with affordability. There's some new legislation that's come down, which allows for more density for certain. I'm not an affordable guy, but it's very positive for our markets because I think it's something that's needed. So we can really service every sector.
Daniel, I'm curious. I'm looking at your website. There are properties below $1 million, and then there's properties that are for tens of millions of dollars or $25 million. So give me an idea in terms of the type of activity you have. What types of properties are selling the most?
The ultra luxury market is probably trading for the highest prices per square foot. We're seeing the most activity in the $1 to $5 million price point. That's where you're seeing a lot of the inventory increases as well, whether you look at the Florida numbers or just the South Florida numbers or the entire East Coast of Florida numbers where we operate. So I would say that that's been the segment where you're seeing the most amount of transactions, definitely.
And that's where you said, what was the percentage that most of these are done in cash, though? Most of this is done in cash?
Yeah, 80% of our transactions are done in cash, and we're still seeing that Q1.
Yeah.
With interest rates going up the way they are, which has definitely affected the market. I think Q4 saw it. We companies across the country were down, over 40%. Thank God you didn't have me on then.
But if people are doing mostly cash, right, they don't care about the interest rates.
They don't care about the interest rate so much. And in a lot of our new development products, whether it's Pier 66 that I just mentioned in Fort Lauderdale or the St. Regis residences here in Miami on Brickell, these buyers have a longer sort of horizon as to when they're going to move in, right? So it's a 3-year, 4-year cycle, and they're okay because they know that interest rates are temporary.
Little footnote here. when the hurricanes come in, this is not where they go, right? Is Miami, is West Palm Beach, those people are safer than like Naples, right?
Well, I would say that we're all in harm's way when Mother Nature wants to have their way.
But it's more up towards the Gulf.
But what's happening traditionally, not traditionally, what's happened over the last 5 years is most of them have been going through the Gulf or missing us here in South Florida and up the East Coast. So we've been very lucky, and I pray that we continue to be lucky.
All right, got to leave it on that note. Hey, Daniel, great to check in with you. Appreciate it. Daniel De La Vega, president of One Sotheby's International
I'll give you a call
Realty,
when I come down.
on Zoom from Miami. We'll see if we can get Matt to Florida. All right now, let's not go to Florida, but let's go to Washington, D.C. and get a check on world and national news. Nancy Lyons in our 99.1 newsroom. Hi, Nance.
Thanks, Carol. President Biden says he's confident that while he's in Japan for a G7 summit, negotiators in Washington will forge a deal that will keep the government from running out of borrowing authority.
The president spoke briefly as his helicopter warmed up. This negotiation is about the outlines of what the budget will look like, not about whether or not we're going to, in fact, pay our debts. The leaders have all agreed we will not default. As the president spoke, Speaker Kevin McCarthy held a news conference in front of the Capitol.
With Schumer and the president saying all along, I won't negotiate the debt ceiling, they have to be separate, you don't have the time to play those political games anymore. I have the grit, the perseverance, and we're going to get it done.
President Biden said he'll stay in touch, cut short his trip, return, and hold a news conference on Sunday. In Washington, Irv Chapman, Bloomberg Radio.
The World Meteorological Association says there's a 2 in 3 chance the world reaches the danger zone on global warming within the next 5 years. The report says it's partly due to warmer than normal Pacific waters from El Nino that will develop in the coming months. That, combined with greenhouse gas emissions, could put the world past the threshold set in the Paris Climate Agreement. Chris Hewitt is Executive Director of Climate Services with the association.
Any restriction we can make to the global warming will be a good thing to do. So trying to limit this global warming as much as we can, I think, will be the right message. We all have a role to play in that, individuals, governments, industry.
Hewitt says this is definitely a wake-up call. It's eerily reminiscent of the chase through Paris streets that resulted in the death of Princess Diana. Prince Harry and his wife Meghan Markle are said to have been chased by paparazzi for more than 2 hours yesterday in New York City. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Lots of earnings after the close of trading, and we've got you covered. Take-Two Interactive Software, known for the Grand Theft Auto video game franchise, soaring in extended trading after the company beat quarterly sales estimates. It also predicted a strong rebound from tough challenges this year. After hours, Take-Two up now by 8.9%. Cisco Systems also delivered a strong sales forecast for the current quarter. Shares, however, are trading lower. Cisco down now by about 1.7%. Stocks higher today with the S&P up 48, a gain of 1.2%. The Dow up 408, up 1.2%. NASDAQ up 157, a gain there of just about 1.3%. Stocks rallied on hopes for a Washington breakthrough. 10-year yield 3.56%. The 2-year 4.15%. Spot gold down $7 the ounce to $19.82, a drop there of 0.4%. West Texas Intermediate crude up 2.7%, $72.76 a barrel. Well, as for the overall market backdrop, Jake Jolly is head of investment analysis at BNY Mellon Investment Management, and he was our guest right here on Bloomberg Business Week.
There's still a lot of uncertainty out there. The data is definitely still pretty mixed, right? Things look a little bit better on the services side, manufacturing, not so much. Obviously, throw in the mix the debt ceiling. That's obviously, I think, a bit of dampening sentiment.
Big day for the regional banks. PacWest Bancorp up today by 21.7%. Western Alliance Bancorp up 10.2%. Zions Bancorp up by 12.1%. Recapping, the S&P advanced today up 48 points, up 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, along with Matt Miller, live in our Bloomberg Interactive Brokers studio here on Business Week on YouTube and Bloomberg Originals. We want to talk a little bit about the M&A environment, because the U.S. government's aggressive stance on antitrust definitely chilling merger activity among the country's biggest companies. We saw that yesterday with the FTC suing to block Amgen's almost $30 billion deal to buy Horizon Therapeutics. So there's a lot going on. M&A deals, I don't know if you saw this in North America, Matt, down about 33% year over year.
Yeah, no, I mean, if I look at MA Go.
That's what I did.
Right, and I see the value of all deals globally, we're at 1.3 trillion. But as we heard from, I think, an M&A reporter the other day told us it was well over 5 trillion at the height. Now, that was for the full year, but we're halfway through, so it's been pretty slow. We've had some big dollar deals go through the last few in terms of announcements pending, right? But you're right, the FTC seems dead set against allowing anything to go through that's over, say, $30 billion.
All right, so let's see what our guest has to say when it comes to M&A activity or lack thereof. Mark Cooper is CEO of the investment bank Solomon Partners, and Mark joins us on Zoom from New York City. So, Mark, we're painting a little bit of a dire picture because it does feel like it's a little rough out there. We also saw it through some of the, I feel like, the big banks in terms of their reporting when it came to M&A. What are you seeing? How would you describe the deal environment for you guys? And remind us kind of what types of deals you typically work within.
So we are pretty standard M&A business, probably more middle market, private equity oriented in our focus, but all within the industry focus or industry areas that we focus on. So I think that number 33% sounded a little light. I think it was down 45% year over year, at least for the first quarter. What we've seen, at least what we saw in April, is a pickup, mainly a pickup in what we refer to as pitches, or the opportunity to talk to sellers about either PE firms or companies about putting transactions on the marketplace. That slowed down a bit, but the big issue in the marketplace is price. These are the moments that you have when interest rates go up or the economy shifts, that there's just a price discrepancy. And we all know it through, the real estate market. When the real estate market is booming, everyone thinks their house is worth top tick. And when the markets go down, they still think it's worth top tick until such time as they realize and they capitulate and they recognize they have to trade. We haven't reached that point. And we haven't reached the point where buyer and seller have recognized that interest rates have risen by 500 basis points, and that the economy is a bit weaker, and that therefore valuations need to be lower. Once that happens, once that moment happens, and maybe it's a little bit of a cork in a bottle kind of thing, then I think you'll see activity. In the M&A markets, it's not about the need to trade, the need to buy, the need to sell. It's about having buyers and sellers who agree to what relative values are.
So, are you telling this to your clients that are selling as well? Because at some point, you know, that cork is going to come out of the bottle, and they might as well get ahead of it.
Well, you could take my position, because it's exactly correct. And so there's a bit of the reason why there were so many pitches, so many transactions gearing up in April or the beginning of the first quarter and gearing up now is in fact get ahead of this curve. And so there's going to be a huge backlog. Because if you think about it, third quarter of last year was tough. Fourth quarter was pretty dead. First quarter was dead. So it's been a while since there's been an uptick in volume. And when you take the private equity community, they have to return capital to their limited partners. They're in the business of putting money to work and raising new capital. If they don't return capital to partners, then they don't get the second pieces, they don't get the new money. So they have to transact, and the backlog is enormous. The backlog both in terms of companies that are ready for sale and where private equity wants to return that capital to their limiteds, and then the dry powder, as we always talk about, that proverbial pocket of money that's available for investment is just sitting around.
Well, that's what I wanted to ask you. How much, quote unquote, dry powder is out there?
You hear conflicting reports, but it's in the trillions, like 1.3 trillion, and that's just looking at private equity. If you take in sovereign wealth funds, if you take in, you take in the reinvestment or the co-investment funds from limited partners, it's an enormous amount of money, and it's not going down. In fact, it's going up. Now, I would say fundraising for new funds and fundraising has been very difficult, but that is a function of returning of capital to shareholders. You would argue that this cycle, which is a cycle that is coming off of a high, where you're buying theoretically at better values, is going to be a very good private equity class. So my guess is when the cork comes out of the bottle, when there's an agreement as to what the new value thresholds look like, I think there's going to be a fair amount of fundraising. I think there's going to be a fair amount of money that's going to be put to work at good prices.
Does it take a recession, Mark, to get that, realignment, if you will, between buyers and sellers? Is that what will do it?
So no, a recession would delay things.
Okay.
So if we, it's all the events that affect value that are anticipated in the marketplace is what causes the disconnect. Once there's transparency between buyer and seller as, okay, interest rates aren't going any higher, the economy's not getting any worse, then you could price an asset. When you're looking forward and there's a disagreement, well, I don't think there's going to be a recession, and I don't think interest rates are going up, and the other side says, well, I think it's the opposite, that's when people go to their corners and can't come to an agreement on price. So we need some stability both in interest rates and an outlook on an economy for those to say, yeah, I'm comfortable in investing at these values, and for the sellers to say, yeah, I think it's appropriate for me to sell at those values. Now, I think the recession fears is not a big piece of what we're hearing. I think it's a lot about interest rates and their effect on valuations.
Right.
And so we think when those interest rates, or when the Fed stops, we feel like there'll be a moment.
All right, we got to run. Mark, look forward to talking again. Mark Cooper, he's CEO at Solomon Partners, joining us on Zoom from New York City. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. After hours, we're keeping track of Cisco system shares. Cisco, of course, the largest maker of machines that run computer networks and the internet. It delivered a strong sales forecast for the current quarter, indicating some customers remain committed to upgrading their corporate technology infrastructure. Sales in the period ending July will rise 14 to 16%, according to Cisco, but that compares with analysts' average projections of a 14% increase. After hours, we do have Cisco shares selling off. Right now, Cisco Systems is down by 4%. Target is standing by its annual outlook after posting higher than expected profit in the first quarter. Today, we did see Target shares advance by 2.6%. And with more on the Target story, here's Bloomberg's Tom Busby.
Charlie, the retailer, says earnings in the current quarter will be no more than $1.70 a share. That would trail the $1.91 average of analyst estimates compiled by Bloomberg. In reiterating its annual forecast, Target cited sales strength in food, beauty products, and household essentials, plus strong earnings in the first quarter. The mixed picture underscores Target's push to regain its footing after a pandemic-era sales boom that ground to a halt last year, leaving the company with stockpiles of unwanted goods. While that problem has been largely resolved, Target pointed to a worsening blow from organized retail theft. Charlie?
And that is Tom Busby reporting. The retail focus tomorrow morning will shift to Walmart. That stock fell today by just about 0.2%. And those are some of the company stories we're following for you at this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Matt Miller here, filling in for Tim for the summer. Carol Masser running the show with me. And it's an exciting, we still have a great lineup coming on. Lucas Shaw's going to come on the show, right?
Well, unfortunately, Lucas can't make it, but we're still going to talk about a great story that he's got.
Okay, we'll talk about Lucas Shaw's story. He's too important to come on this show.
He's a busy dude,
He's
man.
a big deal,
Talking
Lucas
to Peyton
Shaw.
Manning and some other folks.
Okay, so, but we're going to talk about Peyton Manning's Omaha Productions company, and I'm pretty excited about that because I love the Manning brothers and I love what they're doing post-football. But right now, we're going to go to Washington, D.C., for World National News with Nancy Lyons. Nancy?
Thanks, Matt. Prince Harry and his wife Meghan Markle are okay, but they've endured a harrowing chase last night by photographers following a charity event in New York.
The couple's office says the chase resulted in multiple near collisions involving other drivers, pedestrians, and 2 NYPD officers. It called the incident near catastrophic. Police confirm Harry and Meghan were chased and say there were no injuries, collisions, or arrests. New York City Mayor Eric Adams told reporters he hadn't yet received a full briefing, but he called it, quote, reckless and irresponsible. The incident drew immediate comparisons to the 1997 fatal car crash of Harry's mother, Princess Diana. Jill Schneider, Bloomberg Radio.
President Biden is off for Japan, but before leaving Washington today, he honored 9 public safety officers with the Medal of Valor. The award is the nation's highest honor for bravery by a public safety officer.
I don't know all of you, but I do know you. From small towns and big cities, you're cut from the same cloth. You run into danger.
Biden says their bravery inspires others. 2 NYPD officers received the award posthumously, 27-year-old Wilbert Mora and 22-year-old Jason Rivera. They were killed in an ambush shooting while responding to a call in Harlem. The White House is speaking